BAE Systems just confirmed strong performance across its first 4 months of 2026, and the market sold the shares anyway, down 3.2% on the day of the update. That reaction is the anomaly worth examining, because the underlying numbers are not weak. Sales are forecast to grow 7 to 9% from a £30.7 billion base, with operating profits expected to run ahead of that at 9 to 11% growth from £3.3 billion. The order book hit a record £83.6 billion, and because defense contracts are long cycle by nature, that figure represents years of locked-in revenue, not a single quarter spike. So the sell-off was not a reaction to the fundamentals, it was a reaction to the valuation already sitting atop them. BAE shares have rallied 77% over the past year, pricing in a world where the Iran conflict drives perpetual budget expansion across NATO and Washington simultaneously. The consensus read is simple: more war equals more BAE revenue, and the record order book proves the thesis is working. What that read does not account for is where exactly the 77% premium is anchored, and whether the anchors are structural or contingent. The Trump administration's proposal to lift U.S. defense spending 50% to $1.5 trillion for 2027 is being read as structural, but it is still a proposal, and nearly 45% of BAE's revenue runs through that single budget line.
The detail that changes the risk calculus is not BAE's British identity, it is the asymmetric weight of its American revenue. A UK-headquartered company drawing 45% of total sales from the US military budget is not a diversified defense contractor. It is a leveraged bet on Washington's fiscal willingness. The proposed $1.5 trillion defense budget for 2027 is the single most important variable in BAE's medium-term revenue trajectory, and it has not passed. If that proposal converts into appropriations, BAE's 7 to 9% sales growth guidance starts to look conservative rather than ambitious. But the passage of that budget depends on a fiscal environment where U.S. debt dynamics are already under pressure, which means the upside trigger and the downside risk share the same political chamber. This is the countersignal the 77% rally has not priced. Congressional budget negotiations could compress the defense line even as the Iran conflict continues, because deficit concerns and military urgency are pulling in opposite directions on Capitol Hill. The parallel domestic risk is the UK side, where Keir Starmer is currently working to resolve an internal government dispute over the timeline for increasing the UK defense budget. That dispute signals that even in a country that has publicly committed to higher defense spending, the translation from political intent to contracted order pipeline is not automatic. BAE's record $83.6 billion order book provides revenue visibility, but only for programs already under contract. It does not capture what happens to the next intake cycle if either budget stalls.
The point most observers are missing is buried in the cash flow line, and it restructures the investment case entirely. Free cash flow guidance for 2026 is set at above £1.3 billion, a figure that looks weak only until the reason for the step down from £2.2 billion in 2025 is identified. That step down reflects the BA.L aerospace integration cost cycle peaking, not a deterioration in operating earnings quality. BAE paid £4.4 billion for BA.L aerospace in early 2024, and peak integration costs landing in 2026 is precisely what an accelerating cash recovery profile looks like in its trough year. The analyst view that current free cash flow guidance is conservative therefore carries more weight than the headline number implies, because if integration costs normalize faster than modeled, the recovery from £1.3 billion to something closer to the 2025 base happens sooner than consensus expects. That recovery path is the mechanism that would re-rate the stock on fundamentals rather than on geopolitical premium, and it is the scenario the 77% rally has not yet priced. The risk threshold is specific. If the Iran conflict de-escalates before the U.S. 2027 defense budget is formally appropriated, the geopolitical premium compresses at exactly the moment the cash flow recovery is still building. That window, between de-escalation and cash flow normalization, is where the valuation is most exposed. The CV-90 tank program being sold into multiple European armies and the New York Electric aircraft expansion both represent order intake diversification that begins to close that window over a 12 to 24-month horizon.
The resolution of this investment case runs through one condition: whether the proposed $1.5 trillion U.S. defense budget for 2027 becomes appropriated law before the Iran conflict ceases to drive political urgency for it. If it does, BAE's 45% U.S. revenue exposure shifts from a concentration risk to a structural growth driver, and the 9 to 11% operating profit growth guidance becomes a floor rather than a ceiling. The NATO commitment to raise defense spending from 2% to 5% of GDP by 2035 provides the multi-year demand floor underneath that scenario, which means even a partial de-escalation in Iran does not remove the structural case. It only removes the urgency premium priced into the current multiple. The downside path requires two things happening simultaneously: the Iran conflict cooling faster than the budget cycle locks in the new spending levels, and the BA.L aerospace cash flow recovery taking longer than the conservative guidance implies. Neither condition is implausible, but the probability of both arriving together is lower than the 3.2% sell-off on a strong trading update suggests the market believes. The order book at £83.6 billion is the checkoff element introduced at the start of this analysis. It is also the verification benchmark for the bull case, because that figure only sustains the valuation if the next intake cycle, shaped by the $1.5 trillion proposal, refills it at the same pace. The lean here is that the structural tailwind is real, and the valuation premium is partially justified. But the 77% already in the share price means the margin for error on the U.S. budget timeline has narrowed to a point where the trade is no longer about whether BAE benefits, but about when that benefit becomes undeniable enough to hold the multiple. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.